You may have seen ARK Invest's latest stock forecast if you follow Tesla and the financial markets. While many people around the world, including those in government, are opposing Tesla's full self-driving capability, ARK is growing increasingly optimistic about it. In fact, the investment firm's most recent future valuation includes Tesla's potential ROBOTAXI business. Hello, and welcome back to Not Elon Musk, the prime center to get the latest info on everything Elon does, from his companies to finances. The ARK Invest team, led by Cathie, has made available to the public an open-source valuation model of Tesla's stock. This model, according to the firm, is a more transparent way for investors to see the research that ARK Invest has conducted on one of its major holdings. In today's video, we'll look at the top 8 reasons why Tesla share is going to reach $4,600 by 2026. So, without wasting your precious time, let's get started. The firm's 2022 Tesla research includes updates on autonomous ride-hailing assumptions, capital efficiency estimates, and 2026 forecasts. Based on its model analysis, ARK has set a $4,600 price target for Tesla by 2026. According to the firm's research, there is a 25% chance that Tesla shares will be worth $2,900 in 2026 in a bearish scenario and $5,800 in a bullish scenario. This research update is based on ARK's new open-source Tesla model, which incorporates distributions for 38 independent inputs to simulate a variety of possible company outcomes. Tesla's future robotaxi business is a key driver, accounting for 60% of expected value and more than half of expected EBITDA in 2026. The firm anticipates that electric vehicles will account for 57% of the company's revenue in 2026, albeit at significantly lower margins than robotaxi revenue. The chart on the screen breaks down attributable revenue, EBITDA, and value by business line in this model. Number 1. Bear and bull outcomes. They do not provide a single bull or bear case because they dimension the bull and bear outcomes as the simulation's 75th and 25th percentile output. Regardless, the table here presents what the ARK experts believe to be plausible examples for each. The new forecast updates ARK's 2021 open-source Tesla model, which predicted a share price of $3,000 in 2025. Material changes in this version include autonomous ride-hailing assumptions and inputs, capital efficiency estimates, and a 1-year forecast push forward to 2026. Number 2. Autonomous driving. The most recent assumptions for the total market for autonomous ride-sharing at each price point, as well as the likelihood that Tesla will solve for fully autonomous driving. Based on an analysis of consumers' perceived value of time, the company now anticipates greater demand for autonomous ride-hailing at higher price points than they had previously predicted. According to the research, travelers in Western markets value their work-related miles at close to their hourly wage and their non-work-related travel miles at close to half their hourly wage. ARK estimates the total addressable market for autonomous ride-hailing to be between $11 and $12 trillion. Examine this chart carefully to gain a thorough understanding of it. Number 3. RoboTaxi business. They have also updated how the RoboTaxi business feeds into the model, reflecting increased confidence in Tesla's ability to achieve full self-driving capability. The updated downside case assumes a 2026 launch, 4 years later than Elon Musk anticipates. Not only are the commercial launches of Waymo and Cruise bolstering the current view, but so are fundamental advances in AI. The model now allows users to select a robotaxi launch year as well as an adoption rate. Tesla plans to commercialize self-driving cars in 2024. Tesla does not commercialize robotaxis within the 5-year window of this study in 9% of their model cases. Even if robotaxi does commercialize within the forecast window, Tesla's financial results are highly sensitive to the year of launch. Number 4. Maximum annual production increase. Tesla's capital efficiency is also improved by the updated model. Tesla's capital expenditure per incremental unit of capacity has decreased from $84,000 when the Model 3 was ramping in 2017 to $7,700 today. They estimated in last year's model that Tesla would spend $6,000 to $8,000 per incremental unit of capacity in 2025. They now expect Tesla to spend $2,000 to $7,000 per incremental unit of capacity in 2026, based on its much better than expected capital efficiency. While these improvements suggest that Tesla's margins may continue to improve, the more important takeaway is that capital is no longer a bottleneck limiting its growth. Instead, Tesla should be able to expand at the rate that management bandwidth and supply constraints allow. The model accommodates these constraints by arbitrarily limiting Tesla's annual production growth using the max annual production increase input. The ability or inability of Tesla to scale is a critical driver of its business results. The interactive chart here shows the impact of changes in maximum possible growth and different ROBOTAXI launch years on share price estimates in 2026. Number 5. Bitcoin. Tesla's Bitcoin holdings are factored into the model, as are potential price swings to the upside or downside. Despite the fact that Tesla cannot mark Bitcoin up due to its current accounting standards, they believe investors will factor in Bitcoin's impact on enterprise value at its market value in 2026. Bitcoin raises the expected price per share in 2026 by less than 5%. Additional business lines and opportunities may be strategically and financially interesting, but they are too uncertain at this time. They do not believe they will be significant drivers of Tesla's business value over the next 5 years. As a result, they have not accounted for these opportunities in their modeling, and they have no bearing on the price estimates. Number 6. Tesla's energy business. Tesla's cell shortages are likely to persist in the medium term. They do not expect Tesla's energy storage business to contribute significantly to enterprise value over the next 5 years, because its most profitable use of cells is likely to be in electric vehicles. They have not modeled the option value embedded in Tesla's ability to transform its battery systems into virtual power plants that dynamically allocate to overburdened electrical grids. Tesla's energy storage strategy could also be accelerated by vertically integrating cryptocurrency mining and home HVAC systems. For the time being, such options are beyond the scope of this model. Number 7. AI as a service. Tesla has stated that it may take its Dojo supercomputer neural network training available as a service. Dojo, according to Tesla, is on track to do something useful this summer, but its meaningful impact is likely to be beyond the 5-year horizon. They forecast that AI as a service companies with foundation models like Dojo could command up to $20 trillion in enterprise value by 2030. But neither that opportunity nor its option value is factored into Tesla's 2026 model. Number 8. Humanoid robot. Tesla could use factory automation and autonomous driving to bootstrap its learnings, becoming one of the first and few companies to develop foundation models for more generalized AI capabilities, and embedding them in Optimus, its humanoid robot. That initiative's financial impact is most likely outside the 5-year model window. If any of these opportunities materialize faster than expected, Tesla's stock price may benefit. Only time will tell whether Cathie Wood is correct or incorrect about Tesla. What is known is that ARK Invest believes strongly in Tesla's future. So, that was it. Hope you enjoyed watching the video. Like and share if you did, and comment down to motivate us for making more of these videos. Subscribe to Not Elon Musk for the latest videos around the tech and AI businesses. I'll be back with more crazy videos soon. Till then, keep grinding.